Hi. In the last video, we built a DuPont analysis to see what various ratios do over time based on these financial statements. In this video, we will build out our dashboard a little bit to issue debt or equity or buy back debt or equity based on negative numbers there. Put in some checkboxes so we could easily turn them on and off to see the effects, and we'll also need to calculate a share price for issuing that equity. So first, let's talk about debt. And how would the financial statements change if we issued debt? And the way we do that is to manually change the debt down on the balance sheet. But first, let's come up with an amount. Let's say we issue $1 billion in debt or $1 billion in equity while I'm at it. And we want to set it up where I can leave that number in and only affect the statements if I check this box. And this box is linked to cell N20 over here. When I check it, N20 turns true. And just as a refresher, that's by formatting the control and linking it to N20. It's that simple. Let's go to the debt line and put in the correct formula. So if in our model, debt was just carried over from the previous year to hold it flat, we want to say if N20 is checked, then go ahead and use G20, which was that $1 billion of debt, and add it to the previous year. Otherwise, add 0 to the previous year. Let's go ahead and do the same thing to stock while we're down here. We had been holding it flat, but say if N21 is true, then use G21 as incremental stock, otherwise 0. And so debt that we issue or the stock that we issue will increase these rows. And one of my favorite questions on a test is, what else will we need to do to keep our balance sheet and our model in balance? And so we'll find out what else we need to do. So if I issue debt, let's see if it changes any of these metrics up here. It does. It decreased our net profit margin. If for no other reason, then we're paying a lot more interest than we were before. And debt to equity went up significantly because we have more debt. Return on assets went down because we also have more cash. And so the denominator of return on assets got larger. And so we're seeing the right directional effects here, but the purpose of this or the next video will be to draw some pictures over here, see some charts of what exactly we're affecting. Let's check the equity and see if it does the same thing. It also had some effects up here in the year that we issued it and going forward. So now let's go back and see how things change. So if I click issue some debt for $1 billion and look at the balance sheet, debt went from $500 million to $1.5 billion. So what did that change? And how did our model keep itself in balance when we did that? What changed here was the increase in debt. We see that $1 billion that we issued now showing up on the cash flow statement and getting carried through in the changes to net cash from all activities, and therefore the ending cash balance, which, as you know, goes back up to the top of the balance sheet and goes up $1 billion here. So while cash was trending along nicely, we see a huge increase in cash to balance that huge increase in debt. And that's why this model is integrated and keeps itself in balance. So the answer to the exam question is, if we increase debt manually, then what do we have to do to keep the balance sheet in balance? Nothing. The cash flow statement takes care of it for us. Let's go back and look at equity now. If we increase equity, then we go from about 300 in stock to 1.3 billion, so 300 million to 1.3 billion in our stock, and we see that change down here as well, the increase in stock of the $1 billion that we just issued, flowing through to the net cash flow and the ending cash balance and back up to the top of the balance sheet. So the answer to the question of what do we do to keep the model in balance if we manually increase the stock is nothing. Now, when we issue equity, we need to think about what effects does that have. Not only does it increase the equity line and the cash line, but it's also going to increase the share count line. We need to think about how much it increases it. Well, the shares, which were calculated from our model template, need to be adjusted in this year that we issue the equity. So if this box is checked, then the additional shares that we want to add on here are equal to the dollars that we raised divided by the dollars per share, otherwise zero. So how do we estimate a dollars per share for issuing our equity? Well, if you'll recall, at the bottom of the model, we had a ratio down here for enterprise value over EBITDA, and that one required knowing what our market price of equity was. Market price of equity, we said if we had an historical stock price, it would be wonderful to put that in. If we don't, we could just estimate that using a PE ratio. So what we've done is taking our earnings per share, which is just net income divided by shares, multiplied that by a typical PE ratio of 15, and estimated a share price, which ends up pretty close to a round number of 20 here in 2019. So let's go back up and assume that we could issue that equity at $20 per share. And now when we look at the share counts, the basic shares increase by $1 billion divided by $20. They should increase 50 shares. And we'll just let the diluted share count continue to be the same percentage of the basic share count. We're increasing our debt, we're increasing our equity, and when we increase equity, we're increasing our share count. And our model is now working correctly, but it's a lot of numbers. If you're a number person, you might be happy with this. I'm a picture person, so in the next video, I'd like to draw some charts.